Part 1 is cash and accounts receivable. So first we're going to talk about our account that appears on the balance sheet called cash and cash equivalents. Cash is our most liquid asset, and cash equivalents are short-term investments that are highly liquid and easily converted to cash. This would include any type of securities that we hold or bonds that are going to be converted less than 3 months, and we call these trading securities. It's just where we park our money for a few days. Restricted cash is restricted from regular cash and is set aside for specific purposes and will appear as a long-term investment on the balance sheet. Now, bank overdraft treatment, GAAP versus the international standard. The GAAP rule is overdrafts can be offset against other accounts only if they're in the same bank account. Otherwise, they must be treated as a current liability. Under the international standard, we can just throw them all together. So let's take a look at an example. We have a company that has cash in a number of accounts, including $250,000 with Wright in one account and an overdraft of $10,000 at the same bank. In addition, they have a cash balance of $50,000 with Wells Fargo, an overdraft of $10,000 with Citibank, and an overdraft of $5,000 at Low Bank. How would this appear on the balance sheet under GAAP? Well, current assets would be the $250 minus the $10 plus the $50 in Wells Fargo. And then we would set up a current liability for the money in Wells Fargo. No, in Citibank and Wells Fargo Lowe's Bank for $15,000. Now, what does this look like under the international standard? We just throw them all together. And there would be no current liability. Now, trade and sales discounts. Trade discounts are ignored. Example would be an item has a list price of $500, but if you buy so many, you can get it for $300. The amount you're going to book it for is the $300. Sales discounts are different. These are given when customers or we pay early, depending on what side you are. We have the gross method. We record the gross sale and record the discount if taken as a debit to sales discounts. We also have the net method. We book the net amount and then credit sales discount forfeited and add account to sales when the discount is not taken. So let's look at an example. We have sold goods with a list price of $6,250 with a 20% trade discount on account, 3% in 10 days, net in 30. So first of all, remember, we don't consider trade discounts, so we're going to take the $6,250 times 80%, we get $5,000, and that's what we're going to book. This is the gross method. So we book all of it, and then if we're paid within terms, we're going to debit sales discount for the difference between the cash and what we receive. Now, if paid after 10 days, we would just record cash and accounts receivable. Now, what about the net method? We would do accounts receivable less the discount, and when paid, we would just record the cash and the accounts receivable. If they paid after, it would be cash, accounts receivable, sales discount forfeited. Now, sales returns are a little different. Sales returns, merchandisers return for a refund or for credit to be applied to others. Special price reductions, that would be a sales allowance where they say, you don't like the product, why don't you just keep it and we'll give you 20% off the price. That would be a sales allowance. Now, we accrue sales returns and allowances at the time of sale. Otherwise, recognizing sales returns when they occur could result in overstated income in the period of sale and understated income in the return period. Now, accounts receivable. We have to present them at net realizable value. So what that means is we have to take into account that we're not going to collect all of our accounts. We have two methods. One is called the direct write-off. It is not acceptable under GAAP, but required for tax purposes. We write off debt when account is considered uncollectible. The write-off of bad debt affects the income statement and the balance sheet, and bad debt expense is the actual amount written off during the year. Now the allowance method. We set up a contra account called allowance for uncollectibles. The write-off of bad debt has no effect on the income statement or the balance sheet, and bad debt expense is always an estimate. There are two allowance methods. Percentage of net sales, and that's credit sales. This is also called the income statement method because sales appears on the income statement. Or the percentage of receivables, which is also called the balance sheet method because accounts receivable appears on the balance sheet. Now, we can do this two ways. We can do an aging schedule using different rates, or we can use a composite rate. Now we're going to look at some examples. But first, let's define how you calculate bad debt using the allowance method. We have percentage of sales. Bad debt expense is just going to be credit sales times the percentage. That's what you book. That's the easy one. Now, the composite rate based on accounts receivable, whether they give you a percentage or you have to age the accounts receivable, the number you get at the end is what the ending balance in allowance for uncollectibles should be, which means you must take into account the existing balance. And what you're going to do is your bad debt expense is going to be the amount you need to get it to that ending balance. So, the percentage times gross accounts receivable equals the ending balance in the allowance for uncollectible accounts. Estimated ending balance in allowance for doubtfuls plus debit minus credit balance in the allowance count will equal the estimated bad debt expense. Now we're going to look at some examples. Now, my company has a beginning balance of $600,000 in accounts receivable. During the year, they wrote off $41,000 in bad debt. They had total credit sales of $5 million, and they collected $4.9 million. What is the journal for writing off bad debt? Estimated bad debt, the balance and allowance for uncollectibles, and net accounts receivable. So, when we're using the direct method, when we have a write-off, that's when we book bad debt expense. And if you notice, it affects an income statement and balance sheet account. There is no estimate when you're using the direct write-off method. Bad debt expense equals the actual write-off. Ending balance, there is no allowance for uncollectible reserve. Accounts receivable is going to be $600,000 plus the $5 million in credit sales minus the payments minus the write-off gives you $659,000. Now let's take a look at percentage of sales. Same problem. What is the write-off of bad debt? It's going to be allowance for uncollectibles, accounts receivable. When you actually write off bad debt and you use the allowance method, it has no effect on the income statement or the balance sheet because allowance for uncollectibles and accounts receivable are both balance sheet accounts. Estimate of bad debt. We're going to take 1% of the $5 million in sales equals $50,000. So we're going to go bad debt expense $50,000, allowance for uncollectibles $50,000. Bad debt expense equals the estimated bad debt, which equals $50,000. So let's look at our T accounts. There's our starting balances. We had a write-off. We had sales. And then we booked our estimated bad debt. And now we have an ending balance of allowance for doubtfuls of $39 and accounts receivable of $659, and that means our net accounts receivable are $620,000. Now let's use our percentage of accounts receivable or balance sheet method. Same problem. When you write off the bad debt, no effect on the balance sheet or income statement. Estimate of bad debt expense is 5% of ending accounts receivable. So the first thing we need to do is figure out what's our ending balance. So it's $659,000. But we also have a debit balance of $11,000 and allowance for doubtfuls. So when we take 659 times 5%, it tells us our ending balance should be $32,950. However, we have an $11,000 debit balance, so we have to add that to that. So our actual bad debt expense is $43,950. And if you notice, if we plug that in, we get the ending balance we want, which is $32,950. Now, net accounts receivable is going to be $626,050. Now, another way we can do estimate of bad debt is to do an aging of accounts receivable. There is an assumption that the older the receivable, the less likely it will be to collect. Estimated ending balance of allowance for doubtful equals the total amount by age group times percentage equals estimated balance. Remember this also, whenever you do anything that's based on accounts receivable, the number you get is the ending balance in AFU, which means you must take into account the existing balances. So here is an example. We've gone through and we've aged our accounts receivable. You notice that the ones that are 0 to 30 days outstanding, we have the lowest chance of those not being collected. And the ones that are over 120 days, those we are saying that there's a 45% chance we will not collect that number. So now we're going to go through and do the same problem, except our write-off of bad debt, where our estimated based on aging is $40,200. So we still have the same bad debt expense. Our estimate is $40,200. We have a beginning balance. We now have an adjustment of 11. We may have to take the 11,000 into consideration. So we have to book $51,200. And our ending bad debt is going to be $618,800. Now, what happens if somebody decides to pay us after we've written them off? Well, regardless of the method used, you must reestablish the original receivable amount and then record the payment, whether you use the direct write-off or you use the allowance method. So, J. Grant paid $15,000 on accounts receivable written off in a previous year. The direct write-off method, we'd establish the accounts receivable, credit bad debt expense, and then we'd show the payment. This means we have a trail. For the allowance method, we would record the accounts receivable, adjust allowance for uncollectible, and then book the cash. That ends this presentation, part 1.